Hello, I'm Ted Oakley, Managing Partner at Oxbow Advisors, and I have the great distinction today of bringing in one of my favorite real estate people, Tim Wallen of MOG Capital, and they have been a great source of information for us as well as a great source for our investors over the last couple of years, and we really like what they do. But more than that, I want to let you know that Tim is going to be giving you one of the best pieces of information on the current real estate market. I will say this, in my last book, The Psychology of Staying Rich, I mentioned that most wealthy investors have a block of that wealth in real estate. And so we've always felt like, and I know Tim feels this way, that real estate is certainly one of the big building blocks of what you want to own. But with that aside, Tim, welcome. Glad to have you here today.
Yeah, well, I appreciate being here, Ted, and look forward to sharing some thoughts and ideas about what's going on in the market.
So here's the format I wanted to talk today. At the end, we've had a couple of questions come in as well, but I wanted to start with the main sources of what people really are investing in today. At least most of the investors we know across the country are asking questions about certain categories. But I'd like to start with multifamily, if we could. And if you look, you might talk a little bit about the slide you had about the about the Class B and C narrowing to Class A, and what you think about that concept.
Yeah, one thing that's happened over time, if you look over the last 20 years, you've seen construction costs grow by about 3.4% a year, and you've seen rents grow by about 2.8%. So the gap from A rents has grown over time. Like about 15 years ago, the gap between A rents and B rents was about $220 a month. Today, that gap's up to $493 a month. So it's a monster gap between B and A rents, and we truly have a housing crisis and a supply problem for affordability in our country, and I don't see that trend changing anytime soon.
So let me ask you, you also had a piece of information you gave to us about how much home prices had gone up since 2012, and would you talk about that? That looks like rents had not kept up, I suppose.
Yeah. So similar to the same thing I just mentioned regarding construction costs growing materially, you've seen housing prices grow roughly 57% in the last 8 years, whereas rents have grown about 38%. So that delta, that difference between affordability of single-family housing and rents continues to grow. And that's when you talk about real estate in general, I like to keep it simple. It's about the basics of demand and supply. And there's general trends that are happening, and there's general trends that are in place on the demand side, like aging population, people getting married later, student loan debts, all the things. Unfortunately, people getting divorced, and those trends all growing are all demand generators. But all in all, that gap continues to grow, and it's difficult for people to afford single-family housing, which continues the demand side of multifamily very much in place for a long period of time, I think.
One of the questions we had come in, Tim, was on that the house price has gone up so much, so that on they're really charging a lot for a very small house, that a lot of apartment levels are almost the same size as some of the homes, but for a good bit less price. Are you seeing?
Yeah, there's definitely a trend, and again, it gets back to the costs of construction continue to grow. So to make things more affordable, the builders are trying to find creative ways to make it more affordable. So smaller houses, less amenities, more basic houses they're trying to deliver to the marketplace. But again, it's a tough formula. I mean, it's very hard to build an affordable house. It's impossible to build an affordable multifamily. So those trends are really intact.
Could you comment on the vacancy and the rent growth trends that you see?
Sure. Pre-COVID, you were sitting 96% occupied across the country. It's dipped a little bit. You're about 95.5 right now on multifamily. But if you kind of break that up a little bit, pre-COVID, you were seeing occupancies in like the 97% range for BC product, and maybe only 94% in the Class A product. So the amount of affordable housing continues to decline versus the demand, overall. So we expect that trend to stay in for a long period of time. And we'll talk in a little bit maybe about the COVID impact, but it's a very stable environment.
So if I could wrap up on multifamily, I've got one of your pieces here on your view on multifamily, and particularly the MLG focus, capital focus on it, if you just comment on that.
So, overall multifamily, we believe it's a very investable asset class. We believe the demand supply side of multifamily is intact for a long period of time. One of the beauties of real estate is there's people involved, and people make mistakes. There's the human error element, and human error always creates opportunity. Real estate's such a fractured, fragmented industry, and so many people are involved in it, and there's many opportunities that we can capture because of it. But we like the BC marketplace. We like the assets where we can go in there, we can improve the asset, improve the value, improve the cash flows. We also like the Class A space in segments. For example, I was going to mention like a market like Allen, which is a great submarket in North Dallas. They tend to overbuild supply. They tend to build supply ahead of demand growth. And then you tend to get softness on a temporary basis. But ultimately, they use up all the multifamily land that's available. And the demand and the land that they save for corporate relocations eventually fills in. So if you can buy a great asset in a great location in a Class A space, and you pay a great price per square foot or price per unit. We had one deal we bought. It was built 2014. We only paid like $155 a door. Going forward, that's going to cost $200,000 a door, $210 a door to build it. And once that market stabilizes, you're going to be very happy you bought in that location. One other thought: we love buying debt assumption deals. A lot of people don't want to take on existing debt, and so that you always get a depression in pricing. When you buy debt assumption deals.
Do you assume a lot of debt on those a lot of times?
We do. It's one of our core strategies because many people in the marketplace want to use every element of leveraging that they can and maxing leverage out. And we don't mind lower leverage overall in our funds. We're typically 60 to 65% levered in our funds. And by buying a debt, there's fewer buyers that will assume debt. And so it creates better pricing for us.
If I remember correctly, you told me that you had already had the trial by fire on the debt piece in your career way back. So you learned that lesson like a lot of the people did.
Yeah, when you're young and you think you're invincible and you think you'll never make a mistake and you think nothing will ever go wrong. But sometimes stuff does. I never lost money in a real estate deal in my career until 2009. I had one couple deals that had some issues, but really more caused by the banking industry. My worst deal was that our bank went under, and the FDIC took it over, and then our loan was sold to a vulture group that said, "Hey, your loan matured in November 2009. Write the check or give me the keys to the property." So crazy stuff's happened, and lots of lessons learned, and hopefully get better, wiser over time.
I see this. I know you do because you're in the industry, but it seems as though there's a lot of deals out there where they're 80% leveraged. Mm-hmm. And that seems as though that's going to be a tougher trade when you go through a little bit harder time.
Well, yeah, think about the COVID impact, right? All of a sudden you have this sudden shock to the system, and you have a shock to rents, you have a shock to collections. When you're 60% levered or 65% levered, in our portfolio, we can drop collections like 30%, 25, 30% collections and have no problem paying the bills. But if you're 80% levered, it's a much different story. As far as preservation of capital, it's big to manage your leverage. We don't think the additional leverage is worth the additional returns you get from leverage. But again, many deals out there have max leverage.
Let's move on to industrial. I know you have a certain significant piece of industrial, but you might, there are a couple things you had in industrial. One of the ones is that talked about how healthy that particular class investment had been really in terms of what had been happening with it, vacancy versus rent growth, that sort of thing.
Sure. Big picture, you've seen industrial product about 95% occupied. We've seen rent growth in the 4.5%, 4.7% range over the last 6, 7, 8 years. It's a very stable asset class. Again, getting back to the demand supply factors, the demand side, the whole call it the jobs moving back to the United States. We have a lot of jobs coming back. That trend is helping on the demand side for industrial. The e-commerce trends and more industrial space needed for e-commerce are helping industrial. So there's very strong demand factors. You do have to watch out for local supply problems where some people will overbuild on a short-term basis in a market. So you do have to watch out for that local supply story where they build too much. But overall, it's a very stable asset class, and the trends are much in our favor with e-commerce and jobs moving back to the USA, which is a great thing.
Let me ask you, because you mentioned this in a slide, that people will see here about logistics, which obviously in the internet age of everything coming really online, it seems as though you focused in at least on looking at what's going on in the industry.
Sure. If you look at the math of new construction, much of the space is in the logistics space, serving the e-commerce world. And again, that creates a demand generator that helps us on the leasing side and keeping our buildings occupied. You do have the issues with COVID, obviously. I do think the small business guy will get hurt more in this cycle. But the small business spaces that are available, they're built. It's very expensive to build small spaces, and so even though there will be some folks that will struggle, and unfortunately some people will go out of business and move out. The reality is there's another guy coming in for that space because very little of that space gets built because it's so expensive to build.
So are you saying you do not focus on sort of the owner-operator space? You do bigger spaces, or?
Well, we actually do. We'll do both. Again, when we buy real estate, we like what we call it to do is we call them smart deals. When I say smart deals, these are deals where you look at the assumptions, and the assumptions are believable and achievable. So whether it be a high cube, high ceiling industrial distribution type building, or more of a flex building that's 30% office, we will buy in both elements of industrial real estate. We love buying. We bought a portfolio. It was like 1.5 million square feet in Ohio. It was a portfolio of older industrial, not really pretty stuff, but rents that were like $3 a foot or $2.75 or $3.25. But when you buy a portfolio like that, and you understand, like in that market, it was like 97% occupied, and you say, hey, rents are going from $2.75 to $3.25, which is a 20% move in your rents. The guy's got nowhere to go, and so you can get that kind of rent pop. We had one tenant that left. The previous tenant was at $3 a foot. We re-tenanted the space at $4.15, and we spent no money on CapEx doing it. So we love buying old industrial where the rents have been relatively flat. A lot of people, it gets back to that human error thing. A lot of people in our industry do not move rents aggressively. They're very passive in their ownership, and that's that fractured, fragmented industry of private real estate where human error comes in, which creates opportunities for us on the buy side.
So in closing on industrial, you might give us your thoughts. You always give us a good slide on thoughts and sort of your thoughts and the MOG focus on that as well.
Sure. Well, big picture, industrial is very investable asset class. Really, multifamily and industrial are the two favorite asset classes overall by far in our industry. It's kind of like the have and have-nots in the stock world today. But it's a very investable asset class. You do got to watch out local supply growth when you're buying. And you can't just buy blindly. You got to look at, when we buy industrial, we'll go look at the land use plans in the area, look at how much land supply is available for industrial construction, because people will slap up buildings, and so you can quickly have supply growth. So you got to watch that. But we love buying old industrial where the rents are, we think, dramatically below new construction rents, where we have the ability to move rents up and people don't really have much of an option to go someplace else and get something else. So love that. I love buying vacancy. We bought a center, industrial center down in Tampa, about 400,000 square foot center. It was 60% occupied, but we took that from 60% to 92% in about 15 months. And there's mismanagement out there, and it's our job to fix those stories and create value for our clients.
Moving on to office, and by office, I'd like you to make a distinction between office buildings that are, say, smaller, 3 to 6 story, or maybe downtown, very high rise. Where do you concentrate?
Well, again, when we look at office, I kind of view it as for us. Now everybody's got their different viewpoints. For us, it's more of an opportunistic merchant asset class. And when I say that, office has a lot of turn costs as people come and go. So in general, we have a systemic vacancy problem nationwide with office, where we build more than we need. Downtown office, there are exceptions where there's no room to build like a Boston or San Francisco. There's some great locations where there's just not enough land to build anymore. So that could be a great spot to buy, but it's very difficult to buy that stuff. So in general, the office, we think it's a very tough asset class to own because people like to build new. They want that new sexy headquarters, and it creates supply problems that are making a tenant's market and tough for an owner overall as we deal with tenants coming and going.
You provided us too with a really great slide that looks like there's not been much improvement in vacancy rate and in rent growth.
Yeah, so you're sitting at about 90% today in office nationwide. And it just gets back to you're 95% in industrial, 95, 96% in multifamily, and I don't think that's changing. I call it's the CEO problem. The CEO wants that new sexy headquarters, and he wants that great spot for recruitment employees, and they build new, even though their space they're in right now is totally fine. We have it in our market. I'm sure you could look around your market and you can identify companies. We just had a large bank build a brand new headquarters. They didn't need new headquarters. They wanted something new. And so I call it that CEO ego factor that builds new when you really don't need it, but they want it, so they do it and they can. And it creates excess supply to problems that I don't think ever are going away in office. So our viewpoint is you got to be really careful buying office, and our marketplace in general doesn't really take into account the high capex cost of owning office, in my opinion.
Well, I included your viewpoint on the slide because you just gave it to me, so that's good. If you go, Bo, the last thing, if you go to retail, give it. And I think a lot of people probably are hung up in retail, because they're in the wrong place. I know we look at investors. We're in 26 states, so we see investors in a lot of kinds of real estate. But one of the areas I find that they're having trouble with is in this retail spot where, let's say, there's a lead tenant drops or one of them go bankrupt or something like that. But retail is not a big focus for you, if I understand you correctly.
Yeah, we do not do a lot of retail, but we will buy retail. I mean, there are great locations in retail that are very solid to own. I think retail, it's an investable asset class, but you got to be opportunistic. You need to effectively steal something. You got to pay a great price per square foot overall. There's a lot of changes going on with all the internet and all the trends going on overall. But retail is surprising. It's 95% occupied. And if I ask people the question in a setting and I ask people to raise their hands, what do they think retail is occupied? They're all going to say like 75, 80%. But it's actually fairly stable. And the reasons it's stable is there's been very limited supply growth overall and very little new construction. And one thing people forget in retail is there's population growth. And we've been growing about 0.7% per year population-wise. So in 10 years' time, that's 7% growth. Amazon today is only 5% of the retail marketplace. Now it's growing, but population is growing too. So I just think it's a changing place. It's a very difficult place to invest. I would never buy stabilized retail like I would never buy stabilized office because the pricing just doesn't reflect the changes that are in the midst right now and the cost of tenants coming and going, which is extremely expensive from a capital perspective.
Tim, before I get to the structure on MOG, most of the particular one you have open now, I had a couple of questions come in, and the first question was, do you ever think high-rise downtown commercial property will come back to normal?
It's every market's very different, and it's about how much supply has been created versus the demand. You take out the Texas markets like Dallas and Houston and growth markets where a state like Texas is so proactive on job creation, you have an opportunity to have a comeback, right? Because you have that demand growth there. But if you take some other markets where maybe you don't have that job growth story, you don't have that population growth story, excess supply can be a permanent problem. So it's very much a market by market story when you start thinking about that downtown, high-rise thing. Obviously, New York right now is really struggling. we don't invest out there because people pay crazy, stupid numbers for properties on the coast. We don't like that story, but they got real problems right now with all the things that's been happening. So on the demand side in the urban areas.
So the next question that came in had to do, and I think this is probably better for MLG and the MLG investments, because even though you do have some room for 1031 for people that needed to use that, most of your investors, I assume, you're going to have to answer this, I would assume are not necessarily, that's not necessarily their main reason for coming in MLG. But the question was this: Joe Biden has said that he would disallow 1031 exchange, and then he would greatly reduce the depreciation levels for over 400,000. There's a lot of detail on it, but any thoughts on that, on how that, number one, how that would affect the industry, but number two, would it maybe even benefit MLG? I don't know.
Well, first of all, I'm an old Price Waterhouse as a tax manager, Price Waterhouse in my younger days, so I come from that CPA tax mindset. Certainly, having 1031 go away would have a effect on probably a mild effect on capitalization rates. I mean, real estate still has that great return. Interest rates near zero today. Real estate's going to have that great return factor. I actually think the government's going to lose money on the whole deal because people just aren't going to sell. They're going to hold longer. And so you'll see less transaction activity. And with less transaction activity, pricing might even be pressured on the upside because there'll be fewer deals available to buy. And real estate is such a desired asset class that if you have less deals available, the pricing could actually go up without 1031. So who knows? You get away from that crazy buyer that pays too much for an asset because they're trying not to pay the taxes. So it's it'll be interesting how it plays out. But I think the government is overestimating how much revenue they'll gain by getting rid of stuff like this. People just aren't going to sell.
That's a very interesting point of view that I've never thought of, and I'm not certain people watching this probably never thought of it that way, because if you think about it, that would actually be a deterrent to GDP because you wouldn't be doing as much activity.
That's right. They don't look at the economic development side of this, and people are risk takers. If you take away the opportunity to make money, they'll take less risk. And there's a ripple effect that the unintended consequences story is very real when they talk about some policy changes here.
So at the end of this, we'll have a streaming flag where if anyone wants to contact MOG or contact the people at the firm, there'll be information on the firm. But before we get to that, I wanted you to if you could tell us a few things. Number one, I've experienced and seen your reporting mechanisms that you use to your investors. I really think they are excellent. I think they're one of the best in the business, and I'm not trying to put words in your mouth, but they are so far from where Wall Street lands on this stuff, and that's a great job of that. But if you would just spend a few minutes on the structure of MLG, so if there's an investor here that wants to come in, I think you have it's open now, and also how you arrived at why you report so well.
Well, a couple of overall, MLG has roughly 500 people in the organization. You have 9 CPAs, 4 attorneys, land planners, engineers. We're a very, very talented technology-based company. Having people with that public accounting experience is big on reporting. So we use all of the great technology tools, giving people 24/7 access to their information. All the detailed reporting on the financials. So it's we worked really hard to make it easy for people to invest in private real estate, give them good information. Also I was a tax manager at Price Waterhouse, as I mentioned. We think we add another 1.5% to 2% per year in after-tax rates of return because of our proactive strategy from an income tax perspective. And even if they change some of the depreciation rules, the biggest driver of that is doing cost segregation studies, and that will still drive shorter depreciation lives and taking advantage of every tool possible. Most real estate firms don't have that depth of talent inside their organization, so it's a real advantage of ours as a company, overall.
So on the structure, you currently have an offering available now. I think it goes through March of 21?
That's correct.
and that's available. And so people will see the streamer here and how to get in contact if they're interested in either adding to what they already have or putting in new money into what's happening. And so, but you still have opening there.
Yeah, so that fund's a $250 million fund. We always give ourselves a range. This particular fund we can raise between 200 and 250. We're 9 months away from maybe 8 months away. It's March 31 of 2021, but we're at the $165 million mark right now with a lot of checks. We tend to get a hockey stick at the end because right now we're like 65% invested in our fund, and so now you get clear visibility. 2/3 of the assets have been purchased now, so you got clear visibility. The fund's roughly 95% multifamily, 5% industrial. I wish it was 15 to 20% industrial. It's just really hard to find industrial deals. We have not done any office or retail in this particular fund because pre-COVID the economy was pretty strong, and so the retail and office stuff we never found a deal we could make sense buying. And because they were performing reasonably well. But overall, we have availability, but it will go fast at the end. Every fund we've had, all of a sudden, people see visibility and that spikes up in demand, and we're seeing that start of that spike right now. So if there's an interest, now's the time to talk about it.
And if you would give just a minute on structure, I know you have a great preference return and you have a good structure overall with return. Just a thumbnail on that.
Sure. Big picture, we give investors 100% of the cash flow until they get an 8% rate of return on their money, plus the return of all their capital. So investors get all cash flow until 8% rate of return and their capital back. After return of capital and the 8%, the investors get 70% of the upside. MLG gets 30% of the upside for their side of the transaction. This structure is called the European waterfall structure. And what's important about that, for example, if we make a $10 million profit on a property, most real estate guys will put their hand into the bucket and grab 30% of that profit, take that $3 million and put it in their pocket. In our structure, we don't get to do that until you got all your money back at an 8% rate of return. And that's a very unique element. Most real estate funds don't do it that way. They allow the real estate guy to make a profit on each deal as they go. In our structure, we don't see that profit. It's in the balance sheet. We eventually will get our share, but you have a confidence that we're going to work our tail off to get your money back at 8% before we start sharing.
Well, like I say, it's unlike Wall Street, which is fantastic when it comes to the way they structure it. But I want to thank you, Tim, for all this information. For everyone watching, if you have an interest in that, you can see where to contact MOG and look at the deals they have. And Tim, thank you very much. We appreciate you giving us the interview, and all the best out there.
Thank you, Ted. I appreciate the opportunity and look forward to years ahead.
All right, thanks.